In this video, I'll try to break down ICT concepts in less than 10 minutes. A problem with ICT is that it is way too complicated for absolutely no reason. So without further ado, let me show you exactly how to trade ICT in less than 10 minutes. So the first thing, and arguably the most important concept out of any concept that ICT teaches, is again going to be liquidity. Now, liquidity is a very well-known term in the financial space. It is essentially just another word for money, right? We can say there's a lot of liquidity in a certain market. That means there's a lot of money in that market. We can say that a person is a highly liquid trader, which means he's a trader that possesses a lot of money. Now, when an ICT trader says liquidity, he refers to stop losses. So, for example, if I tell you now there's a lot of liquidity at this external range liquidity high, what I'm really saying is there's a lot of stop losses placed at these equal highs or at this external range liquidity high. Now, the reason why this is important is because ICT teaches that the algorithm is coded to hunt liquidity. So if you can figure out where stop losses are resting within the market, well, then you can essentially figure out where price is going to go next. So we have two types of liquidity: external range liquidity and internal range liquidity. Now, an external range liquidity high is the highest point of a given trading range. Vice versa, the external range liquidity low is the lowest point of a trading range. Anything that you see in between that is what we call internal range liquidity. Now, is it super important to know the difference between external and internal range liquidity? No, absolutely not. Now, of course, one thing to note is that external range liquidity highs and lows often have a lot more liquidity than the internal range liquidity highs and lows. Now, the reason for that is quite simple. The external range liquidity are highs that have been there way longer than the internal range liquidity, which again means that people have had way more time to actually place their stop losses at those highs, which of course just leads to way more stop losses. Now, another very significant pool of liquidity is what we like to call equal highs and equal lows. So using these four highs here as an example, the people that place their stops here, they're still in the market because this high has not been swept. The people that place their stops here, they're still in the market because it's not been swept. Same thing here and same thing here. That is what we call equal highs. Now, let's say that this high right here looked like this. Well, then there wouldn't be equal highs because the people who had their stop losses at this high, and this high, well, they would no longer be in the market because this high came up and swept the stop losses at those highs. But again, because they look like this, well, then we have equal highs, which means all the people that have their stop here, they are still in the market. Now, if you're wondering what exchange I use to place all of my trades, I'm using toobit. Now, the reason for that is because they offer some of the lowest fees in the entire industry. And you're in luck because right now I can offer you 50 USDT by simply signing up with the link below. So again, if you're looking to change your exchange or you don't have one yet, well, then I highly recommend that you go check out toobit. Now, the next thing that we'll talk about is the famous fair value gap. If you've been in trading for longer than 2 weeks, well, then you've probably heard the term fair value gap, or FVG, imbalances, inefficiencies. One of those terms you have probably heard. And that's because a fair value gap is essentially an imbalance within the market or an inefficiency within the market. So it is typically talked about as either a fair value gap, an inefficiency, or an imbalance. Now, it is a 3 candlestick pattern, meaning you need 3 candlesticks in order for this to appear. It is quite simple. See, right here we have 3 candles. We have one in the middle, one at the top, and one at the bottom. Now, if the top wick of the bottom candle and the bottom wick of the top candle leaves a gap in between each other, which it does right here, well, then that creates a fair value gap. So, for example, had this wick looked like this, there would be no fair value gap because there's no gap in between this wick and in between this wick. But because in this scenario it looks like this, we draw the fair value gap from this wick all the way up until this wick, and that right there is your fair value gap. Now, I did say that the market is attracted, it wants to hunt liquidity, but also imbalances and inefficiencies. So what we expect the market to do with these imbalances is come down, retest it, perhaps fill in the entire inefficiency, and then rally higher again. Now, that is of course in a bullish scenario, but what a trader will usually do is, let's say that you expect the market to go higher, well, then you could long the market as soon as it hits one of these fair value gaps. Exact same thing for when it's a bearish imbalance, right? There's a space in between this wick and in between this wick, which again causes that imbalance. We expect the market to come up, hit the imbalance, perhaps fill the entire thing, and then continue down lower. That right there, in its simplest form, is exactly what a fair value gap actually is. Now, a less common terminology is what we call displacement. Now, displacement is essentially what I like to refer to as a word used for volume. So let me give you an example. Let's say that this right here is a fair value gap as I've written out. We expect the market to come down, hit the imbalance, and then rally higher. Now, would you classify what we're seeing here as a rally? No, there's not a lot of volume behind this, right? It doesn't really convince me that yes, we are indeed going to go higher, right? No, for me to be convinced that this imbalance is going to hold and shift the entire sentiment, I need to see something like this. So let's say we come down, hit this imbalance, and I am met with what we call displacement, which I am in this scenario right there. Then I have way more confidence that this imbalance is indeed going to shift the entire sentiment, and I can trust that imbalance to send price higher. But again, if I'm met with something like this, which is what we would call a chopping or consolidating market, well then I would probably think that there's a higher chance that this imbalance is going to get violated and price is going to trade through it. So it's important to learn to look for displacement because displacement tells direction. Now the next thing we'll talk about is a break of structure. The break of structure is essentially used to determine when order flow or sentiment is shifting. So let me explain. Right here, we were in a downtrending market, but when we saw the break of structure right here, we can now safely anticipate that the sentiment is shifting from bearish and into bullish. Now, the reason why this is a break of structure is because this right here is an up close swing high. Now, an up close candle is a green candle, a down close candle is a red candle. So this right here is a bullish candle, and we want it to be an up close candle because we are looking for a bullish break of structure. It is a swing high because, again, a swing high is a 3 candlestick pattern. And so if the wick of the middle candle is higher than the two next of it, well then that's what we qualify as a swing high. Now once we get a candle closure above this up close swing high, that right there is the break of structure. Now some people call it a market structure shift. It all has to do with did we sweep liquidity before this or not. It's honestly not that important, so don't worry about it. A break of structure, a market structure shift, whatever you want to call it, that is exactly what it is. Vice versa, when we talk about shifting from bullish sentiment into bearish sentiment, we wait for a down close swing low, which again means the middle candle is lower than the two next to it. Once we get a candle closure below that down close swing low, well then that right there gives us our bearish break of structure. Now when we combine what I've just told you, we get what we call the 2022 model, arguably one of the best and most famous ICT models in the entire world. There are countless of examples of people making a living from purely trading the 2022 model. So let's go over it. Right here we have sell side liquidity, right, the external low. Right here we have the external high, aka buy side liquidity. When we then run down and sweep that external liquidity low, we want to wait and see if we get any displacement. Now in this example, we got plenty of displacement, which again indicates that yes, this liquidity sweep did in fact shift the entire order flow. Now in this example, I didn't include a break of structure. It is not needed. It is simply an extra confluence. So again, it would have been better if this wick had looked like this because that's an up close swing high, and that would mean that this candle closure right here created a bullish break of structure, which just further proves the point that yes, the sentiment is now shifted. We wait for a pullback and then we trade the first fair value gap that we made, which again is going to be the one that we're seeing right here. We long the market and we take our take profit at the external or internal liquidity. That right there is the 2022 model in its simplest form, but let me show you an example of this actually playing out on a real chart. So right here we are looking at Solana. It is a 5-minute time frame. Now keep in mind that this is not a time frame sensitive strategy. That means you can use this strategy on any given time frame. So don't worry about any of that. It also works in most markets. I've personally tested it in the crypto market, in the stock market, in the forex market, and in the futures market. Now again, we have an external range liquidity low here, which we have swept. Another thing that we want to pay attention to is whether the market respects this liquidity sweep. So we've swept the stop losses resting below this low here, which then means that the market will now hunt the buy side liquidity, which again is these equal highs that we're seeing here, because that's simply how the market moves. More often than not, it moves from sell side liquidity, boom, buy side liquidity, sell side liquidity, buy side liquidity. That is how a market moves. So again, because we've just swept the external range liquidity low, we can now anticipate that it is going for the buy side liquidity. So what we want to pay attention to now is whether we displace away from the low, right? That's what we want to pay attention to because that's what confirms the order flow. And as you can see, we got beautiful displacement, and we also got a fair value gap that you're seeing right here. Now, for the people that noticed, this right here is actually a break of structure. It is an up close swing high, and with this candle closure here, we created a bullish break of structure. So what we're going to do now is essentially long the market from this imbalance. We're going to keep our stop fairly tight, target the buy side liquidity that we're seeing up here, and then we are going to play it out and see exactly what happens. And as you can see, it played out picture perfect. So that was ICT explained in less than 10 minutes. Hopefully, I'm not actually sure if I did do it below 10 minutes. But nevertheless, I explained it the fastest way I possibly could. So I hope you enjoyed watching. And again, ICT does not have to be any more complicated than what I just told you.